Did you know that one single law could delay your retirement by 5 years or fast-track it by a decade? Sounds dramatic, but in 2025, that's the reality we're facing. Over 14 major retirement-related bills have been proposed in just the past 12 months, many of them already passed quietly with little public attention. Some will let you save more, retire earlier, and pay fewer taxes. Others, they could cut your Social Security, raise your Medicare costs, or limit access to your own retirement savings. Scary, right? But don't worry, we're here to break it all down. In this video, we'll walk you through the top 10 new laws that could change retirement forever. And trust us, you'll want to stick around for number 10. It's the most controversial one yet, and it might completely change how retirement works in the U.S. Ready to protect your future? Let's get started.
Number 10. Auto-portability between retirement accounts. Imagine switching jobs and forgetting about an old 401k, only to realize years later that it's been eaten away by fees or even lost altogether. Sound familiar? You're not alone. According to the U.S. Department of Labor, over $1.35 trillion sits in forgotten or abandoned retirement accounts. That's money people earned but may never use. That's where the new auto-portability law comes in, and it could be a total game changer. Starting in 2025, when you change jobs, your 401k could automatically follow you to your new employer's retirement plan. No paperwork, no hassle, no rollover nightmares. It's like having a personal assistant who quietly makes sure your money moves with you, without a single step missed. This law is designed to fix one of the biggest leaks in the retirement system, leaving behind thousands of dollars with each job change. And considering the average American switches jobs 12 times in their career, that adds up fast. Even better, it helps prevent fees, forgotten investments, and gaps in your retirement planning. You stay in control, and your savings stay in one place, growing consistently. But here's the catch. Not all employers have adopted this system yet. So now's the time to ask your HR department or plan administrator if they're participating in the auto-portability network. Don't assume your money is moving with you. Double check. And if you switch jobs recently, make sure you track down any old 401ks. A few minutes of effort could uncover thousands of dollars in lost retirement savings. CTA. Has this ever happened to you? Drop a comment below if you've ever lost track of an old account. We'd love to hear your story. And don't forget to like this video if you're learning something new.
Number 9. Penalty-free withdrawals for emergencies. Life doesn't wait for the perfect financial moment. Emergencies happen, whether it's a sudden medical bill, an unexpected car repair, or a family crisis that demands immediate cash. In the past, pulling money from your retirement account early came with a painful price, a 10% penalty plus taxes. But that's starting to change in 2025. Thanks to new federal rules, Americans can now make penalty-free emergency withdrawals of up to $1,000 per year from their retirement accounts. No more draining your savings or maxing out a credit card just to cover a short-term emergency. Here's how it works. You're allowed one emergency withdrawal per year, and you won't be hit with that 10% early withdrawal fee if you're under 59 and a half. The catch? You have to repay the amount within 3 years, or wait until that 3-year window is up before taking another emergency withdrawal. It's a small but powerful shift. For many people, just having access to their own money without being penalized adds a level of financial security that didn't exist before. It also helps prevent the downward spiral of debt that often follows unexpected expenses. However, there's a deeper message here. This law isn't encouraging you to raid your retirement account for everyday spending. It's a safety net, not a budgeting tool. Every dollar you take out today is one less dollar working for your future tomorrow. Still, it's comforting to know that in a true emergency, you're no longer stuck between two bad choices: taking on high-interest debt, or sacrificing your retirement plan's growth. Just remember, emergency access doesn't mean easy access. Use it wisely, and only when it truly matters. Because while $1,000 might not seem like much now, In retirement, with compound growth, that same money could have been worth 5 times more.
Number 8. Digital assets in retirement plans. Just a few years ago, the idea of investing in cryptocurrency through your retirement account sounded like science fiction. Fast forward to 2025, and it's becoming a regulated reality. New federal guidelines now allow retirement plans, like 401ks, to offer limited exposure to digital assets, including popular cryptocurrencies such as Bitcoin and Ethereum. This move is part of a broader effort to modernize retirement investing and give savers more diversified options. But it also brings a serious dose of risk and controversy. Supporters argue that digital assets offer the potential for higher returns and portfolio diversification, especially in inflationary periods. Critics warn that these assets are volatile, poorly understood, and can be manipulated far more easily than traditional investments. The new rules don't mean your employer will automatically add crypto to your retirement plan. Instead, it gives plan sponsors the legal framework and regulatory backing to include digital assets if they choose. But there are safeguards. Offerings must come with clear disclosures, education tools, and limits on how much of your portfolio can be allocated to these high-risk assets. If you're considering investing in crypto through your 401k, here's the bottom line. It's not a get-rich-quick ticket. Prices can swing wildly in hours, and the long-term track record is still developing. But if you're curious and have a well-diversified portfolio, a small allocation, no more than 5%, could be an exciting way to add some growth potential. Still, this isn't for everyone. Digital assets are complex and emotionally charged. Before jumping in, it's important to understand how they fit into your overall retirement plan, how they're taxed, and what role they truly play in your financial future. In the end, this law is about freedom of choice. But with that freedom comes the responsibility to be informed.
Number 7. New rules for annuity disclosures. Annuities have long been a retirement option that many people consider, but few truly understand. For years, the fine print was thick with jargon, fees were buried in complex charts, and the actual income you could expect in retirement was often a mystery. But that's finally starting to change. In 2025, new federal regulations are making annuity disclosures more transparent and user-friendly than ever before. One of the biggest changes? All retirement plans that offer annuities are now required to provide a lifetime income illustration, a simple, standardized document that shows exactly how much monthly income your annuity could provide once you retire. No more guessing games, no more vague promises. Now, if you're thinking about buying an annuity through your 401k or IRA, you'll get a clear picture of what that decision means for your long-term financial security. This change is huge, especially for people nearing retirement who want a guaranteed income stream but are wary of locking their money into something they don't fully understand. It puts the power back into the hands of the consumer, making it easier to compare products, understand long-term payouts, and make more informed choices. For example, instead of seeing a lump sum value like a $100,000 annuity, you'll now see it presented as $540 per month for life starting at age 77 based on your age and contribution history. That's a far more meaningful way to understand how your money translates into security. Of course, annuities still come with pros and cons, and they're not for everyone. But these new rules aim to reduce confusion, eliminate surprises, and bring more confidence to one of retirement's most misunderstood tools. For once, reading the fine print might actually make things clearer, not more confusing. Number 6. Long-term care insurance tax credits. It's one of retirement's biggest wildcards, long-term care. Whether it's in-home support, assisted living, or nursing home care, the costs can be staggering. In fact, the average cost of a private room in a nursing home in the U.S. now exceeds $100,000 per year. And yet, many retirees still don't have a plan for how they'll cover these expenses. That's why a new federal initiative introduced in 2025 is making waves. For the first time, Americans who purchase long-term care insurance, LTCI, may now be eligible for generous tax credits. This means a portion of your premium payments could be subtracted directly from your tax bill,
putting real money back in your pocket. The goal is to make long-term care coverage more accessible and appealing, especially for middle-income earners who often fall through to cracks. Unlike a deduction, which only lowers your taxable income, a tax credit reduces your taxes dollar for dollar. That's a big deal. For some households, the savings could amount to $1,000 to $1,500 per year just for having the coverage in place. These new rules also come with expanded eligibility and simpler underwriting for older adults, especially those in their 50s and early 60s when premiums are more affordable. There's even talk of state-level programs that will match or supplement the federal credit, making this benefit even more powerful. For years, people have avoided long-term care insurance because of its cost and complexity. But now, with a financial incentive built in, it's becoming a smarter, more strategic piece of the retirement puzzle. This law doesn't just encourage planning, it rewards it. And for those who want to protect both their dignity and their bank account in later life, this could be one of the most important changes to come out of 2025.
Number 5. Medicare age and premium threshold adjustments. For decades, Americans have had to wait until age 65 to qualify for Medicare, but in 2025, that could be changing. Lawmakers are now seriously considering proposals that would lower the Medicare eligibility age to 60, potentially opening the door for millions of near retirees to access affordable health care 5 years earlier than before. For many, this shift could mean the difference between working longer just to maintain employer-sponsored insurance or retiring earlier with confidence. Healthcare costs are one of the biggest obstacles to early retirement. In some cases, private insurance premiums for individuals in their 60s can exceed $1,000 per month. Gaining access to Medicare earlier could drastically cut those expenses. But it's not just the eligibility age that's being updated. The premium thresholds for Medicare Part B and D are also under review. Previously, higher-income retirees paid significantly more for coverage. Under the new adjustments, the income brackets are being restructured to make premiums more equitable, particularly for middle-income households who are being hit hard by surcharges. For example, under older rules, a retiree earning just above $97,000 could see their monthly premiums jump by over $100. The 2025 update aims to smooth out those sharp increases and offer a more gradual scale based on actual income. Together, these changes could have a major impact. Lowering the eligibility age offers earlier access to reliable health care, while premium reforms help ensure retirees aren't punished for modest income increases from pensions, part-time work, or Social Security. While the final rollout may vary by state or income group, these adjustments represent a significant shift toward a more accessible and affordable Medicare system. And for those eyeing early retirement or living on a fixed income, this could be one of the most welcome reforms in years.
Number 4. Social Security COLA adjustments. Every year, retirees hold their breath waiting for the Social Security COLA announcement, the cost of living adjustment that determines how much their monthly benefits will increase. In theory, COLA is supposed to help retirees keep up with inflation, but in reality, it hasn't always done the job well. That's why, in 2025, major reforms are underway to change how COLA is calculated, and it could dramatically impact your retirement income. Previously, COLA was based on the Consumer Price Index for Urban Wage Earners, CPIW, a formula that many experts argue didn't accurately reflect the real spending habits of retirees, especially in areas like healthcare, housing, and food. The 2025 adjustment introduces a shift toward the CPIE, or Consumer Price Index for the elderly, which gives more weight to expenses that older Americans actually face. This might sound like a small technical change, but the effects are huge. Under the old system, retirees often saw increases that lagged behind real inflation, especially during years with skyrocketing medical costs. With the new CPIE model, future COLA increases could be more generous and better aligned with actual living expenses. For example, in a year when general inflation is 2%, healthcare costs for seniors might rise by 4%. Under the new system, that spike would be reflected more clearly in the COLA formula, resulting in larger benefit increases for those who need it most. However, the shift also comes with uncertainty. Larger increases in benefits may put more strain on the Social Security Trust Fund, which is already projected to face funding challenges in the coming decades. Still, for current and near-future retirees, this new approach could mean more predictable and fairer annual raises, helping them maintain purchasing power as prices continue to rise.
Number 3. Changes to required minimum distributions, RMDs. For decades, required minimum distributions, commonly known as RMDs, have been a frustrating part of retirement planning. Once you reached a certain age, the IRS forced you to start pulling money from your tax-deferred retirement accounts, whether you needed the income or not. And if you didn't, you'd face a steep 50% penalty on the amount you were supposed to withdraw. Harsh, right? But in 2025, new legislation has brought some long-awaited relief. The starting age for RMDs has now been pushed back to 75, giving retirees more flexibility and more time to let their investments grow tax-deferred. This change is especially beneficial for those who don't rely on their retirement accounts for daily expenses. Delaying RMDs means your money can stay invested longer, potentially compounding for several more years before you're required to withdraw it. Over time, that extra growth can translate into tens of thousands of dollars in added wealth. The law also includes updated penalty rules. Instead of a punishing 50% fee, the new penalty for missing an RMD is reduced to 25%, or even 10% if corrected quickly. It's a much more forgiving approach for those who make an honest mistake. This change also opens the door to strategic Roth conversions. With more time before mandatory withdrawals kick in, you can gradually convert portions of your traditional IRA to a Roth IRA, spreading out the tax impact and potentially reducing your future tax bill. Ultimately, this RMD reform gives retirees more control over their money, something that hasn't always been the case with traditional retirement accounts. It encourages smarter planning, longer growth, and a retirement strategy that's based on your needs, not just government deadlines.
Number 2. Roth catch-up contributions become mandatory. If you're 50 or older, you've probably heard of catch-up contributions, the extra money you're allowed to put into your retirement accounts each year to help catch up on savings. For years, these catch-up contributions could go into either traditional or Roth accounts, depending on your preference. But starting in 2025, there's a major shift. Roth catch-up contributions are now mandatory for high-income earners. What does this mean in simple terms? If you earn $145,000 or more per year and you're making catch-up contributions to a 401k, those contributions must now go into a Roth account. That means the money goes in after taxes but grows tax-free and can be withdrawn tax-free in retirement. It's a big change, especially for those who are relying on the traditional pre-tax model to reduce their taxable income now. For some, this is a smart move. Paying taxes now while you're still working can lead to tax-free income in retirement, which might be worth much more in the long run. It's especially beneficial if you expect tax rates to rise or want more control over your taxable income later in life. However, it also means higher upfront tax bills for high earners who were used to deferring taxes on those contributions. That could impact budgeting, especially for those in their peak earning years who are already dealing with tight cash flow. Employers must also update their retirement plans to accommodate this change, and not all systems are ready yet. So if you're in this income bracket, it's important to check whether your plan is compliant and to understand how this shift will affect your overall tax picture. This new rule reflects a growing trend in retirement policy, encouraging Americans to pay taxes now to enjoy more flexibility later.
Number 1. The Secure 2.0 Act expansion. At the top of our list is one of the most impactful and far-reaching retirement reforms in recent years, the expansion of the Secure 2.0 Act. Originally passed in 2022, this legislation continues to evolve, and the 2025 updates introduce even more features designed to make saving for retirement easier, more automatic, and more flexible, especially for younger workers and late savers. One of the biggest changes is the automatic enrollment provision. Starting in 2025, most new employer-sponsored retirement plans are required to automatically enroll employees at a minimum 3% contribution rate, increasing annually up to 10%. This is a game changer for millions of workers who might not otherwise take the first step toward saving. You're in the plan unless you choose to opt out, which means more people saving earlier and more consistently. Another major update is the boost to catch-up contributions for people aged 60 to 63. Under Secure 2.0's latest revision, individuals in this age range can contribute even more beyond the regular catch-up limits, up to $10,000 extra per year adjusted for inflation. For those trying to make up for lost time, this is a powerful opportunity to supercharge retirement savings in the final working years. The Act also includes provisions to help part-time workers gain access to retirement plans faster, allows employers to offer matching contributions on student loan payments, and even introduces emergency savings accounts linked to 401ks. All of these updates are built on one clear goal: making retirement savings more accessible, more adaptable, and more aligned with real-life financial situations. Whether you're just starting your career or planning to retire soon, the Secure 2.0 Act expansion is designed to support a stronger, more secure financial future everyone. Retirement isn't what it used to be, and that's not a bad thing. As we've seen, the landscape is shifting fast. With new laws rolling out in 2025, everything from how you save, when you retire, how much you keep, and what benefits you receive is being reshaped. These aren't just small tweaks to the system. They're foundational changes that could affect your financial future for decades to come. The Secure 2.0 expansion, Roth catch-up requirements, Medicare and Social Security adjustments, and even the integration of digital assets, each of these laws holds real power. They can open doors, offer new opportunities, and help you build a more resilient retirement plan, but only if you understand them and act accordingly. What's most important to remember is this: knowledge is leverage. The more informed you are, the better decisions you can make, not just for your retirement, but for your family, your lifestyle, and your peace of mind. It's not about reacting to change, it's about preparing for it. So whether you're just getting started with your retirement planning or you're already counting down the days to your golden years, these laws are for both warnings and opportunities. Don't let the complexity of the system hold you back. Start learning, start adjusting, and start planning smarter. Because the future of retirement, it's already here, and it's changing faster than ever.